The looming specter of economic collapse hangs heavy over our world, yet far too many remain indifferent to the gathering storm. As the signs of impending financial upheaval become increasingly difficult to ignore, I find myself growing increasingly concerned about the public's lack of preparedness. Germany's experience with hyperinflation in the 1920s serves as a sobering reminder of the devastation that can unfold when a currency spirals out of control. The cultural memory of that era still resonates powerfully within the German psyche, shaping their collective understanding of the risks we now face. In the Weimar Republic, the German mark experienced a staggering devaluation, with prices doubling on a daily basis at the height of the crisis. Wheelbarrows full of cash were required to purchase the most basic of goods, as the purchasing power of the currency evaporated almost overnight. Enduring scenes of people burning piles of worthless banknotes or using them to wallpaper their homes have become iconic representations of the chaos and despair that gripped the nation. This traumatic episode has left an indelible mark on the German people, instilling in them a deep-seated aversion to the erosion of their financial security. The specter of hyperinflation haunts the collective consciousness, serving as a stark warning of the dangers that can lurk within the opaque workings of the monetary system. In times of runaway inflation, the public often fails to react until the devaluation of their money becomes acutely apparent, much like someone who only confronts a thief once their wallet has been stolen. However, the Germans, with their first-hand experience of the Weimar Republic's collapse, may be poised to respond more swiftly. This cultural memory, forged in the crucible of economic disaster, could prove to be a crucial advantage for the German people as they navigate the current energy crisis, which threatens to further exacerbate the economic challenges. Their willingness to act may be amplified by a deep-seated understanding of the consequences of inaction. But the dynamics at play extend far beyond Germany's borders. The manipulation of the silver market, for instance, has created a significant disconnect between the perceived value of this precious metal and its actual worth. As demand for physical silver assets grows, a shift towards favoring tangible wealth over paper promises becomes increasingly evident. In the wake of the 2008 financial crisis, the global silver market has experienced a remarkable transformation. Prior to the crash, the price of silver was hovering around $20 per ounce. In the years that followed, the metal's value skyrocketed, reaching a peak of nearly $50 per ounce in 2011. This meteoric rise was fueled in part by a growing awareness among investors that the traditional monetary system was teetering on the brink of collapse. However, the subsequent years have seen a puzzling divergence between the price of silver and its fundamental value. Despite ongoing concerns about the stability of the global economy, the price of silver has remained relatively stagnant, struggling to break through the $30 per ounce threshold. This discrepancy has led many to suspect that the silver market is being heavily manipulated by powerful financial actors. By artificially suppressing the price of the metal, these entities are able to maintain the illusion of a stable and functioning monetary system, even as the underlying foundations begin to crumble. The demand for physical silver assets, in contrast, has continued to surge. Investors, wary of the fragility of the fiat currency system, have flocked to tangible stores of value, driving up premiums on bullion and driving down the availability of physical silver. This shift towards favoring real wealth over paper promises has become a hallmark of the ongoing economic unease. This trend towards physical assets is not limited to silver, it extends to gold as well. Historically, during times of economic upheaval, the public has often turned to these precious metals as a hedge against the erosion of fiat currency. The relative affordability of silver compared to gold may even lead to a surge in its popularity as a medium of exchange should a full-blown monetary crisis unfold. As these market dynamics continue to evolve, it becomes increasingly clear that community leaders must possess a deep understanding of money and its complexities. The ability to navigate the turbulent waters of a potential economic collapse will be essential in providing the stability and organization that the public will desperately seek. The ratio of gold to silver, for instance, can shift dramatically during a crisis, rendering conventional wisdom obsolete. Those who recognize these nuances will be better equipped to guide their communities through the storm, offering a glimmer of hope amidst the chaos. One of the most striking examples of this phenomenon occurred in 2008, when the gold to silver ratio spiked to an unprecedented level of over 80 to 1. In normal times, the ratio typically hovers between 50 to 1 and 70 to 1, reflecting the relative scarcity and value of the two metals. However, as the global financial system teetered on the brink of collapse, investors rushed to the perceived safety of gold, driving its price higher while silver lagged behind. This dramatic shift in the gold to silver ratio underscored the importance of understanding the complex interplay between these precious metals. For those who recognize the opportunity, the ability to capitalize on the discrepancy between gold and silver prices could have proved invaluable in weathering the storm. The same dynamic may be at play in the current economic landscape as the world grapples with the fallout from the COVID-19 pandemic and the ongoing geopolitical tensions that threaten to upend the global order. As the value of fiat currencies remains precarious, the public's appetite for tangible assets like gold and silver may once again surge, leading to shifts in the precious metals markets that could have profound implications for those who are prepared to navigate them. But the lessons of the past extend beyond the realm of precious metals. The German experience with hyperinflation, in particular, offers a chilling reminder of the societal consequences that can arise when a currency loses its value. In the Weimar Republic, the rapid devaluation of the mark had a devastating impact on the lives of ordinary Germans. Savings were wiped out, wages became worthless, and essential goods became unaffordable. The resulting social unrest and political instability paved the way for the rise of the Nazi regime, a harrowing chapter in history that the world is still grappling with the legacy of. The cultural memory of this period has profoundly shaped the German psyche, instilling a deep-seated aversion to the kind of financial turmoil that can tear a society apart. As the current energy crisis and other economic challenges continue to weigh on the country, this historical awareness may serve as a powerful catalyst for proactive measures to safeguard the financial well-being of its citizens. In contrast, many other nations around the world appear to be grappling with a profound sense of complacency when it comes to the looming threat of economic collapse. Despite the mounting evidence of financial instability, the public at large often fails to recognize the gravity of the situation until it is too late. This lack of concern is particularly troubling as it suggests a fundamental disconnect between the lived experiences of the population and the realities of the economic landscape. Without a strong cultural memory to draw upon, the public may be less inclined to take the necessary steps to prepare for the challenges that lie ahead. The impact of this indifference can be seen in the public's reaction to the ongoing inflation crisis. As prices for everyday goods continue to rise, many individuals seem content to accept these incremental increases as a fact of life rather than recognizing them as a harbinger of more significant financial upheaval. It is only when the devaluation of their money becomes acutely apparent, akin to the sudden realization that one's wallet has been stolen, that the public is likely to react with a sense of urgency and outrage. This delayed response, rooted in a lack of historical context and understanding, can have devastating consequences when the economic storm finally breaks. In contrast, the Germans, with their vivid recollections of the Weimar Republic's collapse, may be better equipped to recognize the warning signs and take proactive measures to safeguard their financial well-being. Their cultural memory serves as a powerful lens through which they can interpret the current economic landscape, informing their decision-making and shaping their collective response. This heightened awareness may also extend to the public's reaction to the ongoing energy crisis in Germany. As the country grapples with the fallout from the Russia-Ukraine conflict and the resulting disruptions to energy supplies, the specter of hyperinflation may loom even larger in the minds of the German people. The potential for energy shortages and price spikes to exacerbate the economic challenges facing the nation could prompt a swifter and more decisive response from the public. Informed by their historical experience, the German people may be more inclined to demand immediate action from their leaders, unwilling to accept the gradual erosion of their financial security. This contrast in public reaction is not limited to Germany, however. The dynamics at play in the global silver market offer a broader illustration of the cultural and psychological factors that can shape an individual's response to economic upheaval. As the disconnect between the perceived value of silver and its actual worth continues to widen, the public's willingness to confront this discrepancy may be shaped by their own experiences and the collective memory of their communities. Those who have witnessed the devastating impact of currency devaluation, like the Germans, may be more inclined to take decisive action to protect their wealth, even in the face of resistance from entrenched financial interests. In contrast, populations that have not been exposed to the harsh realities of hyperinflation or other forms of economic collapse may be more susceptible to the illusion of stability perpetuated by those who seek to manipulate the markets. Without a strong cultural memory to draw upon, they may be less inclined to challenge the status quo, even as the foundations of the financial system begin to crumble. This dynamic underscores the critical importance of leadership and community-level preparedness in navigating the challenges of a potential economic collapse. As the public increasingly turns to tangible assets like silver and gold in an effort to safeguard their wealth, the ability of local authorities and community organizations to provide guidance and support will become paramount. Those who possess a deep understanding of money, its complexities, and the historical precedents that can inform our collective response will be best equipped to lead their communities through the turbulent times ahead. By drawing upon the lessons of the past and anticipating the challenges of the future, these leaders can offer a beacon of stability and hope in the face of overwhelming uncertainty. The lessons of history are ours to heed, but only if we have the foresight to learn from them. As the world teeters on the brink of a seismic economic transformation, it is incumbent upon us all to open our eyes and prepare for the challenges that lie ahead. The time to act is now, before the consequences of our collective inaction become too dire to overcome.